Welcome to the social media deception, assets versus liabilities. Today, we're diving deep into how social media might be shaping your financial decision. Look at your social media feed. What do you see? Often, it's a perfectly curated life. Luxury goods, exotic trips, and bottles popping in VIP sections. This is what many call the, quote, billionaire hustle. You see the expensive clothes, but rarely the credit card debt. You see the fancy dinner, but not the food blog that paid for it. This curated life often hides a stark financial reality. Remember, social media is a highlight reel. It's not the raw, unedited, behind-the-scenes documentary of someone's life. When you compare your full, unedited life to someone else's carefully constructed highlight reel, you're always going to feel like you're losing. This is the root of financial FOMO, the fear of missing out. Financial FOMO often leads you to spend money just to keep up with a fantasy, chasing illusions rather than building real wealth. So let's stop playing that game. It's time to learn the fundamental difference between merely looking rich and actually being rich. This brings us to the most critical distinction you will ever learn about money: assets versus liabilities. This is the golden rule of wealth. Forget confusing accounting definitions. We're going to use Robert Kiyosaki's Rich Dad definition, which simplifies everything. Simply put, an asset is anything that puts money in your pocket, and a liability is anything that takes money out of your pocket. The direction of the cash flow is the only thing that matters. Now, let's talk about the liability lifestyle trap. The poor and middle class often fill their lives with liabilities, mistakenly believing them to be assets. Think about the partying lifestyle. It's not just drinks. It's club entries, Ubers, late-night food, and new outfits. These are significant expenses that generate zero return. High-end clothes and the latest tech start losing value the moment you buy them. And those monthly subscriptions for services you barely use, they are small drains that add up quickly. While a place to live is a necessity, a high-rent, quote, dream apartment with excessive amenities is often a massive liability, consuming a huge chunk of your income without generating returns. Let's take the classic example of a brand new car. By traditional accounting, it's an asset because you own it. But let's look at its cash flow. A car takes money out of your pocket every month for payments, insurance, gas, maintenance, and repairs. This makes it a classic liability. A car only becomes a true asset if it's putting money into your pocket, like if you're renting it out on a platform or using it for a business that generates more income than its cost. The rich and financially free focus on the asset acquisition lifestyle. They use their money to make more money. An asset doesn't have to be a multi-million-dollar skyscraper. It can be something small and manageable, like a side hustle or business that generates passive income. High-yield savings accounts, stocks and ETFs that pay dividends, and income-generating properties are all examples of assets that put money in your pocket. There are so many types of assets, but the key is to identify one and invest in it. Focus on anything that consistently puts money in your pocket.